Hi, welcome back to another video. In this video, I'll share with you 3 deeply discounted dividend stocks plus 1 quality dividend growth stock that I'm adding to my portfolio or I have on my watch list. They offer a great buying opportunity right now. Like most dividend investors, I'm always looking out for deep discounts on quality stocks that I can add to my portfolio. So let's get on with it. The first stock is PepsiCo, ticker symbol PEP. PepsiCo is down about 16% over the last year and offers both a great yield and growth. A tried and true dividend aristocrat, according to Jim Cramer. It is a consumer staple, meaning that it produces and sells products that are always in demand, not cyclical. So regardless the season, there'll be demand for PepsiCo products. PepsiCo is a global leader in convenient foods and beverages and generated nearly $92 billion in net revenue in 2024. Some of its well-known products include Lay's, Doritos, Fritos, Tostitos, Cheetos, Gatorade, Pepsi Cola, Quaker, Aquafina, SodaStream. The list goes on and on and on. It has a number of recognizable brands and lots of products within those brands. The stock is currently trading very close to its 52-week low at $143 per share. Its 52-week low was about $141 per share. So if you invest in the stock right now, it gives you the opportunity to see significant appreciation as the stock starts to recover. The stock pays a generous dividend of $5.42. And if you invest in it right now, you lock in a nice yield of about 3.8%. The stock has a decent payout ratio of less than 77%, which means that it has room to continue growing its dividends. Its 3-year dividend growth rate, or CAGR, is 7.86%. Its 5-year dividend growth rate is 7.04%. And its 10-year dividend growth rate is nearly 8%, 7.73%. So down nearly 16% over the last year, now would be a great time to invest in PepsiCo. The second stock is Nike, ticker symbol NKE. I'll give you 2 reasons to consider investing in this stock. The first is that Nike has an unmatched brand power. The second is it's trading at a discount. All businesses will occasionally have some turbulence over their lifetime, and it appears that's what has been happening to Nike over the last few years. That being said, the company appears to have strong fundamentals with a management team that seems to have its priorities straight. So investing in Nike right now, when it's down nearly 32% over the last year, will give you an opportunity to lock in a good yield, but to also see good capital appreciation as it starts to recover. Some big investors like Bill Ackman are picking up this stock as well, so perhaps that should be an indication that the stock presents a great buying opportunity right now. A number of analysts rate the stock a hold, buy, or a strong buy with an average target price of $85. So currently at $73, you still be entering the position at 18% below the average price. So if you invest in the stock right now, you're going to see both capital appreciation and continued dividend growth over the long term. Nike has a low payout ratio of 46.6%, which means that it has ample room to continue growing its dividends. Its 3-year CAGR, or dividend growth rate, is 10.15%. Its 5-year dividend growth rate, 10.78%, and its 10-year growth rate is 11.69%. So Nike is an all-round good quality stock to enter into right now when it's beaten down, so that you can see both capital appreciation and to continue collecting dividends over the long term. Now, for a bit of housekeeping. If you enjoy content like this, please consider liking this video and subscribing to my channel. It encourages me to continue making these videos. Also, please note this video is meant for education and entertainment purposes only and does not constitute investment or financial advice. Let's move on. The third stock that is at a good discount but is about to take off is TD Bank. TD Bank is one of the Big Five, one of Canada's Big Five banks that dominate the banking sector. The other four include the Royal Bank of Canada, RBC, Bank of Montreal, BMO, Bank of Nova Scotia, and CIBC. TD was founded in 1855 and has been paying dividends for decades. It currently pays a nice dividend of $4.20 per share. While TD has struggled over the last 3 years due to troubles with its US operations, it finally settled the case with US authorities and was fined over $3 billion in the fall of 2024. So, due to these troubles in the US, the stock was beaten down tremendously and in fact returned -9 over the last 2 years. But it is currently on the mend. In fact, it's up about 10% already this year alone. The long-term outlook for TD remains strong. Not only does it have an impressive cash position of more than $552 billion from its last quarter reporting, it recently sold its stake in Schwab for $20 billion. TD plans to use $8 billion from its sale of its Schwab stake to buy back some of its public shares, known as a share buyback or a share repurchase. A share buyback or a share repurchase is when a company buys back its own shares from the public. This has the effect of reducing the number of shares in circulation and raising up the price of its shares. Now, TD is looking to buy back 100 million of its own shares. That represents about 5.7% of total TD shares in circulation. So now would be a great time to invest in TD stocks before it starts to implement its share buyback program so that the value of your shares will start to increase when it starts to buy back its shares. The stock currently trades at about $84 to $85, which is still significantly below its all-time high price of over $108, which was in 2022. Now, last but not least, and this stock is not on the list because it's discounted, but it is on this list because it offers a great buying opportunity today as a great dividend growth stock. And that stock is Visa. Visa is arguably the best dividend growth stock. Seeking Alpha rates Visa an A. It has a 3-year CAGR, compound annual growth rate, of 17.22%. It has a 5-year compound annual growth rate of 15.41% and a 10-year dividend growth rate or CAGR of 17.74%. As an investor in Visa, you can expect to see a double-digit dividend growth rate into the future, but in the interim, you get to see strong price appreciation. Visa is not a cheap stock by any means, trading at close to $355 at last closing. But compared to MasterCard, it still offers a better opportunity given its lower price point. MasterCard is trading at about $565 per share, and Visa has a lower price and greater growth. While Visa grew nearly 29% over the last year, MasterCard returned about 22%. Visa is a global payment technology company. Today, there are more than 4 billion account holders and more than 130 million merchants in more than 200 countries and territories that accept and work with Visa. Visa has a large moat and operates in an industry with great barrier to entry. It's been said that Visa and MasterCard are like toll roads because while they practically almost carry no risk in a transaction, they get a cut of every transaction. Visa also benefits from currency exchange fees, and the resurgence of travel after the pandemic over the last 4 years has only continued to grow its bottom line and its profitability. So while Visa has a low yield and pays a dividend of $2.36 per share, if you invest in the stock today, you can expect to see significant capital appreciation and benefit from the robust CAGR for many years down the line. The stock currently has a low payout ratio of less than 22% to fuel its projected impressive dividend growth over the next 3 to 10 years. So those are the 4 stocks that I think offer a great opportunity to invest in right now. I own both Visa and TD Bank, and I'm continuing to build those positions. And I have both Nike and PepsiCo on my watch list for when I come into money to start building those positions. Anyway, I hope you enjoyed the video and found it helpful. If you did, please consider liking and subscribing. Thank you for watching.